Okay, bond experts, let's continue with bonds. We're talking about calculating yield to maturity. And let's see what assumptions we make with respect to this yield to maturity. This is a very important concept. So when you calculate a yield to maturity in your financial calculator, or if you use Excel, it doesn't tell you what these assumptions are, which is very important. Okay, so we want to talk about calculating yield to maturity. So we've already done this problem. The question was, if a bond has a par of 1,000, a maturity of 3 years, a coupon rate of 10%, the price is going to be $903.93. I think last time I had 26, 27. That was just a rounding issue. I recalculated it for this problem, so to show you this example. So the par is 1,000, the coupon rate's 8%, the maturity is 3 years, the price is going to be $903.93. So the question is, what is the yield to maturity? What return do I get on this investment? So if I pay $903.93 for the bond, I'm going to get 80 the first year, 80 the second, 80 the third, and 1,000 in year 3. It pays back interest and principal. So we have to solve for the return to creditors, RD. Or RD, a yield to maturity, it's the same thing. The yield to maturity or return to debt holders is 12%. We already calculated that. So when I put in 12% for these 4 components, this one equation with one unknown, I will get $903.93. So if I pay $903.93 to get back 80, 80, 80, and 1,000, the return I'm getting on my investment is 12%. In order to truly get this 12%, a major assumption is made. The reinvestment rate assumption is we reinvest at that yield to maturity, at that 12%. So when I pay $903.93 for a bond, that's going to give me 8% of 1,000, or $80 a year for the next 3 years in interest payments, plus $1,000 in par. When I calculate the yield to maturity, when I use my financial calculator, when I use Excel, I get a yield to maturity or rate of return of 12%. The assumption is I reinvest anything I earn between now, time period 0, and period 3 at 12%. So the reinvestment rate assumption, or reinvestment assumption is anything I earn is reinvested at the yield to maturity. In this case, the yield to maturity is 12%. So anything I earn is reinvested at 12%. So let's go ahead and prove that to you. Let's prove that major assumption, because that's something Excel doesn't tell us, and that's a very important assumption to make, especially when interest rates change, especially when interest rates go down. So that's a very important assumption to make when interest rates change, and interest rates go down in particular. So here's the question. If I pay $903.93 for the bond to get back 80, 80, and 80, and 1,000, the assumption I make is anything I earn between time period 0 and time period 3 is reinvested at 12%. So in year 1, I get an $80 cash flow. I bring it forward at 12% for 2 years. It grows to $135. The $80 I receive in year 2 is reinvested at 12%, and it grows at 89.6. That's the assumption I make. When I get this cash flow, I can reinvest it at 12%. When I get this cash flow, I can reinvest it at 12%. That's my yield to maturity. And that's how I truly get that yield to maturity of 12%. In other words, I get my 80 in year 3, my $1,000 par value back. My 80 in year 2 grew to 89.6. My 80 in year 1 grew to 100.35. I add these together, I get $1269.95. In other words, if I would have bought this investment for $903.93 and gotten back 80, 80, 80, and I'd reinvest these cash flows in year 1 and 2 at 12%, I'm going to end up with $1269.95. In other words, suppose I bought an investment for $903.93, and I can reinvest that, or invest that, and get 12% of my money for the next 3 years. That 903.93 is going to grow to 1269.95. How did I get that? Well, it's a future value equation. Future value is present value times 1 plus r to the t. So the future value is 903.93 times 1.12 to the third. Grows to 1269.95. In other words, if I asked you the following question, you can invest 903.93 in an investment that's going to give back 80, 80, 80, and 1,000. I'm going to call this investment A. Or you can invest your 903.93 into an investment that's going to give back 0, 0, and in year 3 it's going to give back 1269.95. Which one would you pick? Well, you're indifferent between the two if you could reinvest these cash flows at 12%. If you can reinvest these cash flows at 12%, you're indifferent between the two. So what we're showing you is when you receive your interest payments and you got a yield to maturity of 12%, the assumption you make, which is extremely important, is that this cash flow is reinvested at 12% and this cash flow is reinvested at 12%. To prove that to you, the question is, what must I be equal to for my 903.93 to grow to 1269.95? That's the question. In other words, if we put it into our future value equation, if I told you that 903, so future value is present value times 1 plus r to the t. If I told you my 903.93, excuse me, that's wrong. This is live TV, okay? If my 903.93 grows at which rate for 3 years for it to grow to 1269.95? So the future value is 1269.95. The present value is 903.93. It's invested for 3 years. What must R be equal to? So that's the question we're asking. What return do I get on my investment from a 903.93 to go to 1269.95? Well, it's 12%. So they're all equal. So if I tell you you can invest your money in 903.93 and something given 80, 80, 80, and 1,000, or one that's given 1269.95 in year 3, if you can reinvest at 12%, you're indifferent between the two. If you can reinvest these cash flows at a rate above 12%, you would pick this one. You can do the calculation and figure it out. If you can only reinvest these at, say, 5%, you're going to pick this one. So the assumption is, or the question is, how can I reinvest my money? At what rate can I reinvest my money? If you want to take some risk and you think you can get above 12%, you pick this one. If you want to sleep at night and you're happy with 12%, you pick this second one. But the major assumption we make when we buy your bond and price it and get back out the yield to maturity is we can reinvest any cash flows between now and maturity at that yield to maturity. Very important concept. Okay? So let's give another example. Well, let's show what happens if I can reinvest at a different rate. Suppose I buy my bond for 903.93, and my bond's going to give 80, 80, 80, and 1,000. And in order to truly get that 12%, we have just proven it. You have to reinvest at 12%. And you have to know how to do that. You have to be able to prove that to me. You have to demonstrate that to me. Okay? What if you stuck reinvesting at 2%? What if you get the 80, 80, and 80 and you stuck reinvesting at 2%? Well, when I get this investment in year 1, it grows to 83.23. The 80 in year 2 grows to 81.60. When I add these 4 together, I get 1244.83. So my 903.93 grew to 1244.83 if I reinvested at 2%. What return do I actually get on my investment? Well, let's go back to the calculation we just did. Future value is present value times 1 plus r to the t. My future value is 1244.83. My present value is 903.93. what must R be equal to for 3 years for these to be equal? In other words, I invest $903.93 for 3 years, it grows to $1244.83. What must R be? What must my return be each year for this $903.93 to grow to $1244.83? When we calculate the return or the realized return, it's 11.25, okay, or 11.256. So 11.256%. In other words, I bought the investment for $903.93. I was stuck reinvesting at 2%. Interest rates fell as soon as I bought that investment. I'm stuck reinvesting these at 2%. My realized return is 11.256%. So a little bit more than 11.25. According to Excel and according to my financial calculator, it says I'm getting 12%. According to my calculator, it says that if I buy this bond for $903.93 and get back 80, 80, 80, and 1,000, my yield to maturity or return is going to be 12%. But the major assumption we make is when I get those cash flows, I have to reinvest those cash flows at 12%. That's the major assumption we make. I have to reinvest those at 12%. And how did we prove it? We reinvested them at 12%. We showed that our money grew to $1269.95. We would be indifferent between this investment and an investment where I invested my $903.93 into an investment given 12% each year. It would also grow to $1269.95. So I'm indifferent between the two. So I have proven the yield to maturity of 12%, that I have to reinvest at 12%. Because the $903.93, if it's getting 12% every year for 3 years, it grows to $1269.95. My 80, 80, and 80 also grows, reinvested at 12%, grows to $1269.95. If I can't reinvest it at 12%, if I fortunately could reinvest at a higher rate, and you can do this on your own, if I could reinvest at 20%, I'm going to get a higher return than 12%. I'm showing you that if I'm stuck investing at 2%, so if I buy the bond, investments of like risk are giving 12%, I'm stuck reinvesting at 2% because that's the best option I can have. What is my true return? My financial advisor says you're getting 12% on your money. My Excel and financial calculator tell me I'm getting 12% on my money. That's not true. I'm reinvesting at 2%, my 80, 80, and 80. These two are reinvested at 2%. My money grows to $1244.83. That's equivalent to my $903.93 growing to $1244.83. That's the same as me getting 11.25% on my money. So because I was stuck reinvesting at a lower rate, my realized return is 11.25%. What I actually got on my money is less than what my financial calculator told me, because my financial calculator makes a major assumption. So the first thing you want to know is what's the major reinvestment rate assumption we make when we solve for yield to maturity. And the major assumption is we reinvest at that yield to maturity, in this case at 12%. The second thing you want to do is be able to prove the yield to maturity assumption. You want to prove that you have to reinvest at 12% in order to truly get 12%. That's the second thing. So we have to reinvest at 12% and then prove that that's the same thing as $903.93 growing at 12% each year for 3 years to $1269. And then the third question is, okay, what if you reinvest at 12%? What if you can only reinvest at 2%? If you can only reinvest at 2%, what's your realized return? Well, it's going to be less than that 12%. And so you want to solve for this realized return. If you remember from another finance class where you talked about an internal rate of return, that's kind of the same thing as yield to maturity. So yield to maturity and internal rate of return we're solving for the interest rate. We're solving for the return on investment must get. Okay? If you remember, the internal rate of return is something called the modified internal rate of return. And the modified internal rate of return is saying, okay, what if you don't reinvest at that internal rate of return? So when you solve for yield to maturity or internal rate of return, the assumption you make, the reinvestment rate assumption you make is you reinvest at that yield to maturity internal rate of return. If you don't reinvest at that internal rate of return and yield to maturity, then what is your realized return? Well, that's what a modified internal rate of return is. So I'm not going to do this in this class, but the modified internal rate of return is exactly what we did here. Is what if I'm stuck reinvesting at a different rate? That's the question. So the question I'm asking you is, what if I can reinvest at a higher rate? What if I can reinvest at 22%? So when I buy this bond for $903.93 and it pays 80, 80, and 80, what if I can reinvest those cash flows at 22%? So you're going to have to bring these cash flows forward at 22%, add them together, put it into our equation. You're going to get a different future value, put it into the future value equation, and solve for R. So you're going to, you can do it on your own. So bring this forward at 22% and then solve for R. So bring them forward, get your future value amount, here's your present value, solve for R. Is it going to be above or below 12%? It's going to be above 12% because we're reinvesting at a rate higher than 12%. So at the end of the day, when I solve for yield to maturity and get a yield to maturity of 12%, the major assumption I'm making is I reinvest at 12%. If I'm stuck reinvesting at a return at a rate less than 12%, my realized return is less than 12. For example, 2, when I reinvested at 2, I got a little bit more than 11%. If I reinvest at 22%, my realized return is going to be higher than 12%. So the question is, when I buy this bond, if I think I can reinvest at a higher rate than 12%, I like getting those cash flows earlier. When I don't think I can reinvest at a return of 12% or more, then I would prefer to get no cash flows in year 1 and year 2 and get everything at the end. So it depends upon how much risk you're willing to take. So I want you to make sure you understand that major assumption, because that's very important. Interest rates are constantly changing, causing that reinvestment rate to change. Okay? In closing for this section, when we talk about a yield to maturity or return to creditors, what return do you want? So you're a banker and you're lending money. What return do you want on your investment? So if I sell something, if I sell this eraser and I want a 10% return on my investment, and if I buy the eraser for $100, and I want a 10% return, I price it to sell at $110. So what return do we want? I want a 10% return on this. I price it to give 10%. I paid $100, I sell it for $110. Well, when you are a banker and you're in the marketplace and you lend money, the return you want on your debt instrument is made up of several components. And there are many presentations for this, or different presentations. Here's a simple one to think about. The first thing you want to do is you want to be compensated for your sacrifice. You want to be compensated for not having your money. You want to be compensated for having to give it to somebody else to do something with it. So the first thing is you want some risk-free rate of return. You want a return even if you're not taking any risk. You want compensation strictly for your sacrifice and not having your money. So the first thing you want is a risk-free rate of return. You also want to be compensated for inflation. I call this IP, the inflation premium. IP is the inflation premium. You want to be compensated for inflation. Inflation is too much money chasing too few goods. Prices are bid up. This is what happened to oil prices when they hit $145 a barrel. China was doing well, India was doing well, the US economy was doing pretty well, and we had limited supply. So too much money chasing too few goods. It drove up prices. So we want to be compensated for inflation. We want to maintain our purchasing power. So you're a banker, you lend me money to buy your car, you want to be compensated for your sacrifice, you want to keep up with inflation, you want to maintain your purchasing power. The next thing you want to be compensated is for maturity risk. Maturity risk has to do with the maturity of the loan. A 15-year mortgage is going to be less expensive than a 30-year mortgage. It's shorter maturity. A shorter term loan usually is less expensive than a longer term loan. It's less maturity. So the next thing you want to be compensated for is maturity risk. Okay? Longer maturities have higher premiums. Okay? The next thing is DRP, the default risk premium. If I invest in a bond, or I invest in a company that has a chance of default, I want to be compensated for it accordingly. So if I'm a banker and I'm lending money to you to buy something and you have a higher probability of default, you're not as stable in terms of income, I'm going to charge you a premium for that. So this is a default risk premium. And the last thing is an LP, which is a liquidity premium. A liquid asset is quickly converted to cash and minimal and no loss in value. Real estate's a classic example of something that's not very liquid. If I'm invested in something that's not very liquid, I want to be compensated for it. So we call it a liquidity premium. So I have a corporate bond that's not very liquid. I want to be compensated for it. If it's liquid, I expect less compensation. So if you think of a savings account, you lend money to a bank, you give money to a bank, right? You make a net investment. So your return you're expecting is you want to be compensated for not having your money. You want to be compensated for inflation. Well, if it's a savings account or short-term CD, not much inflation in a few months. The maturity risk premium is a short maturity, not going on, a lot going on. It's a bank insured by the FDIC. The government's going to, quote-unquote, bail the bank out if they struggle and not much default risk. And liquidity premium. You don't have a whole lot of problem with it being liquid. It's going to mature in 3 months and you can actually sell it back to the bank earlier. You may have some penalty or lose interest, but not much liquidity premium. So as a banker, as anybody in a debt world, the return you want is equal to a risk-free rate. You want to be compensated for sacrifice. Then we all add on a premium for inflation, right? We want to maintain our purchasing power. We want to add on a premium for longer maturity instruments. The further out in the future we go, the more risk, the more uncertainty, the higher the return. We want to be compensated for default. If we have a company that's struggling and they're selling bonds and they have a pretty high probability of default or higher probability than another company, I want to be compensated for that. And if I buy a bond that isn't very liquid, I want to be compensated for that, or any instrument that has less liquidity. And so you add in all the risk components and you get the return you'd expect in your investment. Okay? So that's a simple presentation on how to price debt, what a banker, what the marketplace is looking for when they buy a bond. How do they calculate the return they want on an investment? So you have a corporation that's struggling, higher probability of default, we're going to have a high default premium. So two companies, everything's the same except one has a higher probability of default, we're going to have a higher premium. Two companies, one's not as liquid, they don't have as many bonds outstanding, for whatever reason it's not as liquid in the marketplace, you want a higher premium. Treasury securities are very liquid. So U.S. Treasury securities don't have a whole lot of default risk, they're backed by the government. The federal government can print money that you can't do legally. So very little chance of default, even though recently they were downgraded. Liquidity premium, the marketplace likes U.S. Treasury securities, not a whole lot of liquidity premium. Maturity risk, the further maturities, the higher the risk, the more uncertainty, the higher return. And an inflation premium is I want to be compensated for an increase in prices. So inflation is too much money chasing too few goods. I want to be compensated for prices going up. I want to maintain my purchasing power, and I want to be compensated for not having my money. If you in this class and you acquire these skills, you want to be compensated for your sacrifice. So, a risk-free return. Okay?